Ladies and gentlemen, good day and welcome to the Solutions Limited Q4FY21 earnings conference call hosted by Arihant Capital Markets. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Ms. Jyoti Singh from Arihant Capital. Thank you and over to you, ma'am.
Good evening, everyone. On behalf of the Arihant Capital, we welcome the management of Solutions Limited for Q4 FY21 earnings conference call. Thank you for taking time out. We have with us today Mr. Srinivasan HR, Vice Chairman and Managing Director, Ms. Subhana NS, Executive Director, Mr. Lalit Mahapatra, Chief Financial Officer, Dr. Ayaz Hussain Khan, Global Head Generic, Ms. Soumya Kaur, Clinical Head for APAC. Now, I would like to hand over the call to the management for future outlook. Thank you and over to you, sir.
Thank you very much and good evening, ladies and gentlemen, joining the Q4 earnings call of Take Solutions. On behalf of my management, we are very pleased to be taking this call, and post the commentary, we will be very happy to take questions. Overall, we've had a very satisfying quarter. Margins have gone up significantly. The margins are at pre-COVID levels now. This was the focus over the last 3-4 quarters that we wanted to achieve was very strong cash generation and a very strong EBITDA growth as we move forward. And it's very important that we sustain this. I'm happy to tell you that on the business side, we've had 100% renewals from all the top pharma companies that we deal. We've also had 100% renewals from all the federal agencies in the United States with whom we do work. We've added 16 new logos during the quarter, several of them multinational in nature. There are good tailwinds for us to grow and continue to deliver profitable growth. For the quarter, our revenues were $30.1 million and the EBITDA was $5.7 million, the adjusted EBITDA. I'll come to the adjustment in a little bit. In terms of operating cash profit, we were at $4.6 million. That's up from $750K in the previous quarter. Going forward, I think this is going to be the trajectory. We are going to look more and more at EBITDA growth, at strong cash profitability. And while top line is important, I think cash generation is going to be the way to focus. Just coming to, in terms of the cost side, I think we've done a lot of hard work over the last 4 quarters. And just to give a context, our employee costs, which used to be around 28 million in Q3 of FY20, we are now at about 12.1 million. So we've delayed the organization. We've moved a lot of work to in our SG&A expenses also have been cut very drastically. And it's on the back of this that we've been able to deliver a good EBITDA. We did have an exceptional item in the quarter of impairment of non-current assets. First, to say that these assets are non-cash in nature, so this expense is non-cash in nature. Every year we stress test all the assets in the company for impairment. This is important to give an accurate assessment of the true value to all stakeholders. In the non-current asset category, so this year we tested all the fixed assets, the goodwill, and when it came to the non-current assets category, there were certain assets that were a part of the acquisition of Ekron Akinova in 2016 and WCI in 2011, which were carried on the balance sheet and which the independent valuer felt would not be able to generate the kind of cash flow in future. So it would be appropriate to accurately state the value of that. So we've taken a charge of 9.23 million to that effect. The objective of this exercise is to give a fair value of the company to all stakeholders, and it is a prudent practice, and we accepted the valuer's recommendation and therefore have gone this. Other than that, I think we see very strong tailwinds in the business. And at this point of time, maybe we can start off by how the generics business is shaping up and give you a flavor of some of the exciting work that we are doing. I'll invite my colleague, Dr. Ayaz Khan.
Thank you, Mr. Srinivasan. Happy to share my thoughts, friends, in this analyst call once again. And let me give you a little background of the generics business. While you may be aware that we do the bioequivalent studies, basically for getting the molecules to the market, and the speed is the essence here. While we do most of our work for the pharma companies in the US and Canada and in Europe, I would say that there is a slight shift in terms of the nature of the studies that we do now. So we are more into the complex studies, which includes, clamp studies, which are for the diabetic molecules, which includes inhalation studies, for all the MDIs, aerosols and nasal sprays and things like that. And we also are into the peptides and the research around that. While COVID of course, had been very unprecedented the way it came in, but it also gave us a lot of opportunities to work on. As we move in this call, you will also hear more about the COVID trials that we have had. While I would like to say and share with you that we were fortunate to have one COVID phase 1 study, which we did for a pharma company. Of course, it was a collaboration of two pharma companies, one outside of India and one within India, who came together for doing this trial. So these are treatment opportunities that are now coming into place, and which is helping the patients to tackle this disease better. One other opportunity which we again worked on during this pandemic time is a molecule which is used for diabetes. And here again the idea was to complete this study. So this would include studies which we have completed in the healthy subjects, and these are called clamp studies, and basically these are analogs of insulin. So we work on these type of complex molecules. When I say clamp, to give a little scientific background of it, these are run in very specialized clinical facilities, which have the capability and are equipped to do these studies, as we would be clamping the glucose for each and every subject with whom we are making this product undergo the testing. So here again, the testing happens to ensure that both the formulations which are tested and the results that are brought out from this are comparable in nature. For this, we use very high-end equipments, and I'm happy to share that we have those sophisticated LC-MS machines with us, which are used to analyze these samples. This also includes an analysis, which is called an ECLIA-based analysis. So which is also part of this study, and we and our labs are equipped to do this testing as well. So now that means we have completed successfully the first part of this project, and now we have handed over the second part of this project means to our clinical team. So Ms. Soumya means who is going to take over this call from here on. I mean, she would probably also touch upon this, wherein we would be testing this product in the patients. So I would just like to conclude, not taking too much time, to say that the focus is shifted now. I mean, more towards complex generics, 505(b)(2)s, and very complex molecules, including inhalations, which we are currently working on. So let me hand over this mic back to Mr. Srinivas, and then we can take it from there. Thank you.
Thank you, Dr. Ayers. I think we've long way in developing our expertise, and that's why I wanted Dr. Ayers to give a flavor of the kind of scientific expertise we've been able to build in the company and the type of clinical facilities that we have in the company. What's been very interesting is that while the environment generally over the years because of COVID has been damp, we've been involved in some outstanding COVID studies. Last year we did a set of successful COVID studies, and now again after the second wave we are involved in a bunch of COVID studies. And to talk about that, I invite Soumya Kaur, our Executive Vice President for Asia Pacific, to clinical. Soumya, over to you.
Thank you, Mr. Srinivasan. Good evening, everyone. As mentioned by Dr. Ayaz and Mr. Srinivasan, we have had some good set of COVID programs which within the clinical function we executed, implemented and delivered in the last few months. There was a set of programs which we delivered across in India, APAC, and as well as in other additional countries within Middle East. So the team actually, they came together and we have been successfully managing these programs in a remote, virtualized, decentralized mode. And also in the last few weeks, we have successfully submitted the data. Some of these studies have completed, and the data has been successfully submitted to the regulatory authorities of the respective studies what we performed. Some of the data has got submitted to the FDA and also to the Indian regulatory authorities here and as well as in some of the APAC countries. With the wave raising coming and then going down, we have also had some good opportunity and discussions where there was quite a bit of uptick in COVID programs itself, with a lot of additional clients coming and having the discussion in terms of the execution model and how we can make it happen in a different way. These are the clients which are global, and now we have an opportunity in terms of developing a model for these clients in a global way, inclusive of countries in India, Thailand, and as well as other countries like US. So there has been a very good collaboration, cross-functional collaboration with the teams in US and as well as in APAC. And this collaboration has helped us to also complement each other in terms of the knowledge, transfer the knowledge, have a lot of lessons learned from the previous execution what we have had. This has given us a very good platform in terms of working on new programs and new clients. So we have successfully added new logos for whom we are working in global and much bigger studies in the next few months, which we will be delivering. So we are in the initial planning stage. So yes, COVID was challenging. We have had challenges in terms of execution, in terms of managing, but there has been a lot of lessons learned, and this also paved a way for us in terms of building a new model in terms of executing clinical trials across various geographies. Thank you, everyone, and handing it over to Mr. Srinivasan.
Thank you, Soumya. So just to reiterate the point that for a company of our size to be involved in 9 COVID programs is something that is very creditable to the expertise and the quality of delivery that we've been able to do, and the success we've had in submissions with the regulatory authorities. So our order book looks very good. We are at about, our total order book for the company stands at about $173 million. And I think we are well placed to go through the next few years. I think we're very well placed in how we're building the asset in the company. In terms of future outlook, as I've said, the COVID second wave has obviously had an impact. We hope that we'll still be able to deliver profitability continuously. I don't think that will be a challenge. But obviously, clinical trial is a contact-intensive business. So there are starts and stops that happen, and every lockdown creates situations that are beyond our control. However, I think we've done well. The future outlook is good. We will focus more on cash generation and EBITDA growth and cash profitability, and that's the way forward. I think with these, I'll pause here, and we'll be happy to take further questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Subrata Sarkar from Mount Intra Finance. Please go ahead.
Hello. So this is regarding impairment, sir. Like why we are forced to take this kind of impairment, because this is considering the fact that a substantial portion of our asset is intangible. So it is very difficult for an ordinary investor to ascertain how much impairment it will happen. So first, why this impairment, and what is the guidance regarding this impairment? Means, although I understand there will be every year there will be a fair valuation, and then there is a possibility that there will be a drawdown of the asset. But still, if you give some assurance on that, otherwise it's become very difficult to ascertain what is the real value and fair value of the asset of the company.
So that's a great question. See, we need to understand that the revenue of the company has come down substantially from the previous years on the back of closures of EU and certain actions that we've had to take. So when there is such a sharp fall in revenue, the assets that create that revenue have to be tested, and the fair value of that asset has to be stated. And in that, intangibles have to be tested. So including the goodwill was completely tested, and therefore there were no issues as far as the goodwill on the balance sheet goes. But as far as these assets, which were acquired in 2011 and 2016, it is important to understand the potential of these assets to generate future cash flows to carry them on the balance sheet. We had to take the call, and I think we took a prudent call, and it is in the benefit of all stakeholders. We don't expect this to be a routine occurrence. This is a one-off occurrence of impairment. But it's also a year where COVID has impacted the company substantially in terms of revenues. So it is very appropriate to restate the fair value in the balance sheet.
Hello. Sir, is there a possibility similarly on the receivable side that at some point of time we may find it difficult to recover a significant portion of the receivables, and in that case we have to write down the receivables also?
No. I think if you see the receivables as a percentage of the balance sheet, it was 33% earlier. It has come down to 27% of the balance sheet. Our intention is to bring this down to in the early 20s as we move forward. And all the customers that we have are A-grade customers, and we don't have receivables problems. Pharma customers have their own delayed payment cycles, but there is never an instance of an issue of not being able to collect. So there will be no problem with the receivables.
Sir, last two questions. First is is there a further possibility our revenue will continue to decline in the future? Number one. And second, sir, if you throw some light to understand these as we claim we deal with only large pharma companies. So we know in general experience a lot of Indian pharma companies, although I understand they are in a different domain altogether. They are in a product domain, whereas we are offering service on the on the R&D side, but still when we consider Indian pharma companies, there are certain companies which are actually supplier or do business to a great extent with those large pharma companies, but they never have that kind of a receivables higher receivable problem. So why we do face it, and is that the case to be in our kind of business model?
No, I think we can have two. My assessment is, first, I want to correct you that it's not that we do business only with large pharma companies. We do business with small pharma companies. We do business with Indian pharma companies, all of that. The answer to your question is that most of these companies, and they are public companies, right? You can go and to their balance sheet and look at their days payable, their DPO days, which is a public document in the public domain. And you will find that most of them, there are companies where the payable days are even 240. There are companies, most companies, big companies, payable days will be 180 plus. So these are public documents. So you can go there and see what those companies are saying as their payable days.
Okay, sir. And in terms of sales, are we expecting degrowth in sales also in the near future? That's my last question. Thanks, sir.
We are not having a degrowth in sales. We have enough orders. Our issue is our ability to execute the orders. Whenever lockdowns happen, there are start, stop. Then we are not able to predict what the revenue cycle will be. So revenue is not a function of only the sales, which we have more than adequately covered, but it's more a function of how much of the sales we are able to consume in the form of execution. I think we've done a good job over the last 9 months. Certainly, we've understood the COVID protocol and we've adjusted our delivery capability to it. But still, when lockdowns happen and constraints are thrown, they will impact revenue. I don't see too much of a challenge for us in the near term, but if there are continuous shutdowns, then obviously it is going to impact revenue because this is contact-intensive business.
Okay. So just one follow-up, sir. In that case, as you explained, our revenue is also a function of how much we can deliver. So in that respect, sir, we have seen a significant cut down in our employee expenses. Now, sir, the way since we are into a the knowledge-based industry, so employees our key strength. So in that case, if we are reducing the employee expenses and reducing the number of employees, so in that case, aren't we sacrificing with our future business prospect?
See, it is a very difficult path to tread. You have to look at what is your current cash generation and requirement and where the cash will come from and what the future will require. I think we have optimized to that, so we don't expect any further reduction in people or employee costs. Whatever harmonization had to be done has already been done. From here, we will look to grow the business as things improve.
Okay. So thank you, sir. This is all from my side.
Thank you. Our next question is from the line of Abhishek Jain from Arihant Capital. Please go ahead.
Thank you, sir, for posting much improved numbers. Sir, already you have talked about one of the sir, sir, can you throw light on the liquidity scenario, how the things are shaping up right now, and what are the payments which we have to do in the next 1 to 2 years?
Okay. The liquidity scenario is, I think the balance sheet numbers are already there. I think we have about 2 or 3% of our balance sheet size is in the form of cash. And given where we are, liquidity continues to be tight, but we are managing the situation admirably. We do have debt obligations, which we recognize. And we have been able to develop very credible alternatives to fund the debt in the balance sheet. So in the next maybe 3 to 4 weeks, we'll have some announcement on a board-approved plan that we have on how we're going to handle our payments. We would not and we don't need any restructuring of our debt. I think we'll be able to pay it off comfortably.
Okay. Is there okay? Second question, sir, on current quarter, if you can throw some light on how the things are shaping. Are we expected to be profitable this quarter, or like to maintain the profitability in this quarter also?
See, in the current quarter, there has been an impact because of the lockdowns, but I think we will be profitable. We need not worry about profitability. We will certainly be profitable, but there will be marginal impact on the revenue because there have been lockdowns, so we can't wish away those. There will be marginal impact on the revenue, but we'll be profitable.
The last question from my side, sir, can we see in next 2 years down the line, can we see a 25% of margin because of the cost rationalization exercise we have taken in this thing, and are we able to reach the $50 million run rate which we were doing it earlier?
See, I think there are several questions in this question. So I don't think I'm in a position to comment on 2 years forward, because the pandemic has created a situation where we are just able to comment on what is coming in the next 3 months and the next 6 months. And if we meet those commitments, we're feeling quite grateful. Yes, our intention is to try and improve our margins to the mid-20s or at least early 20s. But I think that will need a steady state business, and I think we are at least a year and a half away from that at this point of time. In terms of reaching full capacity utilization, see, we don't want to run behind revenue. We want to run behind profitability, and we want to have very profitable growth. And given the circumstances of the pandemic, we don't want to be very aggressive on revenue growth, which could lead to other problems that so there are some learnings from the past. So we're certainly looking at accelerating the revenues. We have orders to accelerate the revenues, but we want to look out for profitability at the same time. And given the conditions that prevail, operating conditions that prevail, I think we'll be able to deliver good results continuously.
Thank you, sir. Thank you.
Thank you. Our next question is from the line of Nirav Dalal from Maybank Kim Eng Securities. Please go ahead.
Thank you for the opportunity, and congratulations for steady set of numbers. A few questions from mine. One is on the revenue side. Q on Q, there hasn't been much of an improvement in revenues, so the reasons for the same, and related to it, is the liquidity situation impacting our revenue growth? So that would be number one. The second question would be on the employee headcount. Now that the employee cost has come down, is it because our business mix is moving from, say, services to clinical? Is that the reason we would be able to manage business at this employee level? So these are my two questions. I'll have other questions as well.
So let me take the last question first. Clinical business obviously is going to be the strong growth driver as we move forward. Dr. Ayaz and Swami substantiate that the clinical business key growth drivers. But I think we should not read too much into the employee costs has come down because of a set of, we delayered the organization. We moved a lot of work back to India and strengthened the India operations. We're trying to now look at other countries in ASEAN where we can have possibly low-cost operations. We're also trying to look at low-cost locations in South America if feasible. So I think employee cost will hover around here. I think obviously we'll have to factor in the increments that went in during April 2021. So there'll be an increase marginally in the current quarter that we're going on, in terms of employee cost. Now, in terms of Q-on-Q growth, see, there are two reasons. Yes, liquidity is a reason so we need to discharge several obligations which we have to keep current. So there is a limitation in the way in which we can fund our growth. It does impact. But it's also because sometimes these are milestone-based recognitions of revenues. So, for example, in a clinical trial, if you can recognize the revenue only after you've done 50 patients, and if you've done, let's say, 40 patients or 30 patients at the end of 31st March, that revenue cannot be recognized. It will come in the current quarter. So there are a variety of reasons to that. I think we should be able to grow well from here on. We won't have challenges of either revenue or profitability as we build the business again.
Right, sir. So, and then moving ahead, harping on the impairment piece. Now, one of the pieces in the impairment was related to the generics business. So that I think we had recognized as an asset in FY20 and now FY19 or FY20, and now we have written it off. So just wanted to understand, though we are very strong on the generics side, why that write-off? That would be one. And then as we are moving business out of the USA to India, are we running the risk of impairment on the US acquisition on the services side that we had done?
No, we have stress tested all the acquisitions. There is no impairment that is required. In fact, everything is going
in the coming years, because as we are moving towards more on the clinical side, are we running the risk of impairment on that side of the business?
Are both clinical. That is what I'm trying to tell you.
Sure.
So therefore, there is no risk there. The acquisitions in the US were clinical acquisitions, and we are growing exactly of the business. So there is no need for impairment.
Correct. I was specifically asking regarding Dataceutics. So I believe there we are doing more services based, or we are actually moving into clinical in that business.
So Dataceutics clinical business, and there we have actually grown the headcount in the US.
Okay.
So there is no need. I think you must understand that when I say that we are trying to do whatever we can do well in India, we are trying to do it in India, right?
Correct.
So it is not necessary that we have shifted everything back to India. That is not the assumption you need to make.
Correct.
We need a global delivery model that is optimized for performance first and cost next. And we are trying to achieve that. So whatever we are able to offshore, we are doing it in India. But there is a lot of activities that we are doing in the US. And the Dataceutics piece of the business that we acquired, whatever the headcount was when we acquired it in the US, that headcount was substantially thereon. So I think we should not take a theme out of context and try and apply it to every business, right? And next, as the generics business goes, the one that you are referring to in FY19 is different. This technical know-how we are referring to is what came as a part of the acquisition in FY16.
Okay.
It has nothing to do with FY19. So we are now not using that technical know-how, or we don't feel that there is a potential to use that any longer.
Okay.
And that is why, out of abundant prudence, we've taken this step.
Right. So, and just lastly, so should we assume that by FY22 and we should be back to our normal 110 days for receivables and stuff?
Yeah.
So how should one look at it that way?
I think, because of the compression in revenue in the previous previous FY that went by, it will show up a little differently. I think we should come back to those during the current year. I'm very positive we'll be back there.
Great, sir. Thank you. I'll come back for follow-ups. Thank you.
Thank you. Our next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Hi, thank you for taking my question. Am I audible?
Yes, you are, sir.
Yeah, okay. Sir, my first question is regarding the debt status. If you could spell out how much debt is outstanding currently.
Sorry to interrupt, Mr. Babla. I think if you're on a speaker mode, can you switch to a handset? Because it's fluctuating now. We can't hear you.
Can you hear me? Yeah.
It looks like Mr. Babla's line is disconnected. In the meanwhile, we'll move to our next question. That's from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, hi. Thank you very much, sir. So just wanted to understand, now you did speak about the challenges that you're facing and maybe the normal steady state scenario, maybe 1.5 years down the line. So that is when, so by when we are expecting a pre-COVID level kind of revenue one can come back to? Will it require that 1.5 years that you have been talking about to reach a normalized level of revenue? So any kind of comment on those lines would be helpful.
See, we'll have to take it in two parts. First, do we have the orders to come to that level of revenue? The answer to that is yes. I think with the current orders on hand, we can actually be executing revenues of about maybe 35-40 million per quarter comfortably. We should be able to execute. But are we able to do that? There are physical constraints now because of different issues, protocols for COVID, and the extra time that it takes, how we manage the remote. Those constraints, I don't know when they will go away for me to reflect accurately and tell you. But given my general understanding of the scenario of what is happening, I think 12 to 18 months is a good time frame to think we'll come back to those levels.
Understood. Yeah, that's it. Thank you.
Thank you. Our next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Yeah, hi. Sorry I got disconnected last time. Actually, so my question was around the debt status right now. What is the current, if you could spell out for us, what is the current outstanding debt versus what it was last quarter and same quarter last year? And in the last conference call, you had mentioned that by this quarter end, we would have a strategic plan for repayment of debt. So why is it pushed for another 3 to 4 weeks? And what would be the dues for repayment in the next 1 year, and how do we plan to meet them? That's all from my side.
So I won't have the debt schedule right in front of me to be able to relate that, but roughly our debt outstanding is in the order of about $70 million. Why it would take another 3 to 4 weeks? Whenever we give a time frame, we give a time frame in the hope that we'll be able to do it by then. But there are there is a process, there are a set of approvals that need to be in place, and unless those approvals come from the right quarters, we will not be in a position to make a public announcement. All I can say is that we have very credible options before us for solving the debt that's sitting on the balance sheet in Take Solutions, and you should hear from us in the next 3 to 4 weeks.
Okay, sure. And sir, just last, if I could squeeze in that the order book this time you mentioned was $173 million. What was it compared to last quarter and last year? Okay.
So last year, I think was some 270 or thereabouts. I'm just recalling from memory, but I'm not sure about it. Last quarter was 170.
Okay. Thank you so much. Best of luck in the future.
Thank you.
Thank you. Our next question is from the line of Nitin Gandhi from KIFS. Please go ahead.
Yeah. Thanks for taking my question. It's good to hear that you'll be more or less running positive profit in FY22 all the quarters, as the revenues are unlikely to be below 30 and employee costs are significantly controlled at 12-13. So is there some indicative employee to revenue link ratio which can be in place for going forward? Because it has moved significantly better from 1.3 to almost 2.5 now.
No, I think we look at the business and go about it. So we don't look at ratios to how the business should be run. We just look at different models that work, and on the back of COVID, we had to architect a different delivery model, a different cost model of how we were going to run the organization. And that's what we've achieved. But we'll try to keep the employee cost, contain it to these percentages of revenue.
Mm-hmm. But are they current employees good enough to the 3740, which is a normal required revenue, which you also expect in going forward? What could be the price on that?
There may be marginal additions that we will need, but we have a good base to grow from here. We should be able to deliver more revenue with the same employee base.
Okay, so maybe 10-15% rise, but with maintaining the ratio, you can reach 40 million.
Yeah, I think so.
Okay.
Yes.
There was some, while giving some explanation, you said there are some requirement that 50 patients are done, you can't undertake the billing. So can we have such unbilled revenue where like you are near threshold 40 odd and you are not able to bill it and the cost is getting debited to the P&L? Is there some way whereby can you tell us that yes, these are the like postponed revenue or unbilled revenue which can flow in a subsequent quarter? Because I don't think it's going to spill over beyond one quarter.
No, it won't spill over. There will be some unbilled revenue that will spill over into the next quarter.
Can it be significantly somewhere around 10% of the billing what you undertake, or it's less than that?
No, it should be less than.
Okay. Now coming to the assets which you have taken impairment, are we now confident enough that yes, going forward the assets which where we are carrying forward in the books are enough to generate at least 1 times or 1.5 times of the revenue, or some other yardstick, if not 1.5? Can you share that yardstick? Okay, that going forward this is going to be the potential revenue generation.
No, I think I don't want to get into sharing yardsticks at this point of time, but I can certainly assure you that we brought in a third-party agency, a very credible agency, to test all the fixed assets, intangible assets, current assets, non-current assets of the company completely. And this was the outcome. So we genuinely believe that there is the rest of them are very good and they are very productive assets, and we'll be able to deliver value using that. See, in a year where the revenue has fallen steeply, it is very difficult to manage ratios of asset turnover, etc. So only when things normalize, those data points can be looked at. So in a year where revenue fell sharply, if you ask me how the asset turnover ratio will behave, I think you can also see it is not appropriate. But are we making efforts to bring that back? The answer is yes, and we will come back.
Yeah, so maybe not now. Maybe if, when we talk 1 or 2 quarters down the line, if you can share some more color on this, that yes, now we are good enough and we expect this.
It would have improved, and maybe you won't even ask the question. It would have improved by then.
No, we would, at least I would like to monitor those numbers rather than keep saying. So if you can share, it will be more helpful. So some color like intangibles are so much and fixed are so much. Or maybe geography-wise. Yeah, that's the suggestion. If you can do something on that. Thank you very much and all the best.
Thank you.
Thank you. We'll take a next question from the line of Dhwaj Kanungu from Shreji Finserv. Please go ahead.
Hello, sir.
Yes.
Thank you for the opportunity, sir. My question is, so what are the cost reduction measures that were taken this year, and what is the outlook for FY22?
Cost reduction measures have mainly come in 2 parts. The first is we've substantially lowered the employee costs compared to the previous years. We've delayered the organization. We've closed a few offices. We've let go of a lot of senior people in leadership, and that's visible. So we stand at about 12.1 for the last quarter in terms of employee costs, as opposed to 28 or 29 that used to be in the previous FY. In terms of SG&A, we now have a very low office footprint. We've remapped our entire office footprint. And obviously, with travel having gone and no meetings and conferences, we've moved to a digital mode on most of our marketing efforts. That also we've been able to control substantially. It's around $5.2 million per quarter. I expect it to stay there only for this FY. I don't want to give a revenue outlook except saying that the entire focus is going to be on keeping high EBITDA and maintaining cash profitability. That will be the focus. I do not want to give any revenue.
All right, sir. And one more question was that you guys have opened a subsidiary in Singapore. What would be the main activities of that subsidiary, sir?
We will be looking at, there are certain Southeast Asian countries where we will need to run operations, places like Vietnam, Korea, etc., where we are getting requests for managing clinical trials. So we will need a company to house some of those things. That is the reason for opening that subsidiary.
All right. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the floor back to Ms. Jyoti Singh from Arihant Capital for closing comments.
Thank you everyone for the participating. It was a wonderful participation from all. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, on behalf of Arihant Capital Markets, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.